You think that once your Social Security check lands in your bank account, it's untouchable. Nobody can take it. Nobody can freeze it. It's simply yours because you earned it. That's not quite true. There are 3 rules already written into federal law that decide exactly how protected that money really is, and most people living on a direct deposit have never heard a single one of them. Here's why that matters. Rule 1 is good news, and it works automatically, without you lifting a finger. Rule 2 is the exception almost nobody expects, and it's affecting hundreds of thousands of seniors again this year. And Rule 3 is a quiet mistake, one you could make by accident, that can strip away your protection completely, even though you never did anything wrong. Stay with me to the end, because the third one is the one people regret not knowing the most. Let's start with the good news, because you deserve to hear it first. Federal law requires your bank to automatically protect 2 months' worth of your Social Security, disability, or federal benefit payments the moment they're direct deposited into your account. Not eventually. Not after you fill out a form. Automatically the day the money lands. Here's what that means in real terms. If you receive $1,500 a month, your bank must recognize that up to $3,000 in your account, 2 months' worth, is shielded from most creditors trying to collect through a court order. Credit card companies, medical debt collectors, personal loan companies, the ordinary debt collectors of everyday life, they cannot freeze or seize that protected portion, even if they've already won a judgment against you in court. Your bank is required by federal regulation to look at your deposit history, see the benefit payment coming in, and hold that amount safe for you to use. Picture a woman in her early 70s who fell behind on a credit card years ago after her husband's medical bills piled up. The collection agency finally sued her and won a judgment, and 1 month she opens her banking app terrified that her entire account is about to be frozen. But because her Social Security is direct deposited, the bank had already flagged 2 months of it as protected before the judgment ever reached her account. The debt collector could see the money sitting there. They could not touch it. She never had to hire a lawyer or file a single form to make that happen. It happened because the deposit itself was coded as a federal benefit, and the law required her bank to protect it the moment it landed. That's Rule 1, and it's the part of the story most financial channels stop at. But there are 2 more rules, and they're the ones that actually catch people off guard. Rule 2 is the exception, and it's important precisely because it's not a rumor. It's active right now. That automatic 2-month shield we just talked about protects you from private creditors. It does not protect you from the federal government itself. Through something called the Treasury Offset Program, the government can take up to 15% of your monthly Social Security check for a small number of specific debts: unpaid federal taxes, court-ordered child support or alimony, and defaulted federal student loans. That last category is the one worth paying close attention to in 2026. Collections on defaulted federal student loans were paused for years, starting with the pandemic, then briefly resumed, then paused again while the Department of Education rolled out a new repayment system. That system, called the Repayment Assistance Plan, launched over the summer of this year, and involuntary collections, including offsets against Social Security checks, have been tied to that rollout. Several 100,000 borrowers over the age of 62 are currently in default on federal student loans, many from loans they co-signed for a child or grandchild decades ago, and are within reach of having a portion of their monthly check reduced because of it. Unlike Rule 1, this doesn't require a court order, and it doesn't care whether your account is otherwise protected. It's a federal agency collecting a federal debt directly from a federal benefit. Think about a retired man who co-signed a student loan for his daughter back when she was in college, then lost track of it after she took over the payments herself. Years later, unbeknownst to him, those payments stopped. The loan went into default, and it sat quietly on his record. He has no idea until 1 month his Social Security deposit arrives noticeably smaller than usual. That's the offset. If this describes you or someone in your family, the single most useful step is contacting your loan servicer about rehabilitation. 9 on-time payments over 10 months removes the default status entirely and stops the offset, or looking into the new income-based repayment options before a reduction ever hits your check. And now, Rule 3, the one that surprises even people who think they already understand all of this. That automatic protection from Rule 1 only works as long as your bank can clearly see where the money came from. The moment you move your direct deposited Social Security into a joint account with different funds mixed in, or transfer part of it into a separate savings account, or combine it with money from another source, the paper trail that made it automatically protected can disappear. Legally, the money is still exempt, but your bank no longer has an easy way to prove that on its own. If a garnishment order arrives after that, the bank may freeze the account first and ask questions later, leaving you to prove, sometimes in court through a formal claim of exemption, that the money in there was protected benefit income all along. Picture a widow who, out of simple convenience, has her Social Security deposited into a joint checking account she shares with her adult son, an account that also receives his paycheck. When an old collector resurfaces, chasing a debt that technically isn't even hers, the account gets frozen because the bank can no longer cleanly separate her protected benefits from his ordinary income. She's legally in the right. But instead of the protection happening automatically the way it's supposed to, she now has to prove it with paperwork, with bank statements, sometimes with a lawyer, while her money sits frozen in the meantime. The fix is simple, and it's the kind of thing nobody tells you until after it's already gone wrong. Keep your Social Security or other federal benefits flowing into an account that holds only that money, not a joint account with a family member's paycheck, not an account you also use for a small side business. Just the benefit, landing clean, month after month, so that if anyone ever comes looking, the protection kicks in, the way the law intended, automatically, with no fight required. So here's what these 3 rules add up to. The first one is a real protection, and it's already working for you right now without you having to do anything. The second one is a real exception, and if you or someone you love has an old defaulted federal debt sitting quietly in the background, this is the year to deal with it before it reaches into a monthly check that's needed for rent and groceries. And the third one is entirely within your control. Keep the account clean, and the protection the law promises you stays exactly as strong as it's supposed to be. None of this is something your bank is going to sit you down and explain. They follow the rule when they're required to, and they stay silent about the exceptions and the traps, because it was never their job to warn you, only to comply. That part is yours to know. So take one simple action this week. Log into your account and check whether your Social Security or benefit deposit is going into an account that holds only that money. If it isn't, consider separating it. And if you, or your spouse, or an adult child ever co-signed a federal student loan that fell into default, make the call to the loan servicer today before the offset finds its way to a check you're counting on. Understanding these 3 rules doesn't cost you anything. Not understanding them is what costs people. Thank you for watching.